You guys ready for a controversial topic? Just hear me out and listen to what I'm saying. Wait until the end, and then you guys can let me know what you think, what you disagree about, what you agree about, down in the comments. But let me just give a little bit of information about myself. So, I was actually born and raised in the same city that Kamala Harris was. I was born in Oakland, California, and raised in the Bay Area. Earned my MBA from a local university, and then spent 15 plus years in corporate finance, working just in California. Now, the thing that I keep hearing about is about how Kamala Harris wants to implement a tax on unrealized capital gains. And this is actually a carryover from the proposal from the Biden administration, where they want to tax a minimum of 25% and up to 44.6% on unrealized capital gains. So, for those of you that don't know, simply put, capital gains is really just any increase in assets. Let's say the increase of a value on an asset that you own. For example, if I own a house that today is, let's say, $500,000, let's say I bought it for $500,000 today. And let's say in tomorrow, for easy math, let's say it's worth $700,000. That means I have a capital gain of $200,000. Now, it doesn't have to be your house, it can be your stocks, let's say artwork, let's say maybe your car, etc. But not all capital gains is equal, let's say. So a short-term capital gain is when you sell an asset that you've held for 1 year or less. Now, a long-term capital gain is when you sell an asset that you've held for longer than 1 year. So short-term capital gain is, let's say if you had that increase within a year of owning it. In that exact example, if you sold it tomorrow for $700,000, that would be a short-term capital gain. If you sold that same house, let's say 2 years later, that would be a long-term capital gain. So short-term capital gain is taxed as the same as your regular income tax, while long-term capital gain is currently taxed at maximum 20%. And then what is an unrealized capital gain versus a realized gain? So the thing that changes it from an unrealized gain to a realized gain is a simple fact of selling it. For example, that $500,000 home that I own, if by tomorrow it's worth $700,000, but I haven't yet sold it, that is a unrealized capital gain. But if you switch the scenario and I did sell it, that makes it a realized capital gain. And normally, the sale of assets are only taxed on realized capital gains. That's how it currently works in the US. But Kamala Harris's proposal is to actually start taxing on unrealized capital gains, even before you sell anything and before you receive any cash for that gain, to increase that long-term capital gains rate, tax rate, from 20% to a maximum of 44.6%, and at minimum said to be at least 25%. This only applies to those with at least $100 million net worth. So it's a policy that's not meant to affect most people living in the US. So just again about unrealized capital gains, it's basically theoretical money. It's not money that you actually have or that you actually made. It's actually someone that's estimating what your asset is, let's say right now, versus from what it was when you paid for it. So if this proposal is actually put forth and written into law, that means any of that, let's say, hypothetical money, you'll have to pay taxes on it. So just off the bat, here are some of the issues that I see with this currently. And you can let me know if I'm wrong, if I've made any mistakes, I'm not perfect. Please let me know down in the comments below. But the latest I've heard is so far they will tax you on this theoretical money that you've made. Well, let me just give you an example. We've all heard of startup founders. They don't actually have a lot of cash on hand. They don't have a lot of money in their bank accounts. But let's say as someone who started a company gets enough investments that their company is valued at, let's say, $100 million. And then for some reason something else happens and now they're valued at $200 million. Well, under this proposal, that would mean that they now owe $25 million off that $100 million increase. But a lot of startups are actually strapped for cash. They don't actually have that actual cash. That $200 million is kind of imaginary. It's imaginary money. It's not actual cash in the bank. So let's say somehow they actually managed to scrounge up the money to pay that $25 million in taxes. Let's say something bad happens and now that startup is worth $0, is valued at $0. Nothing's changed with the company's financials, let's say hypothetically, but the valuation now is just set at $0. What happens to that amount of money? Let's say the unrealized gain. Now it's an unrealized loss. Do they get that money back? And from what I can tell, I think the answer is no in this case. So that means they are now down and out of luck and down of that $25 million, and they're broke and bankrupt. But they've already paid $25 million, but they actually have no money now. So frankly speaking, I don't see how that really works out too well. Now let's say we're not talking about an example of a startup, but let's just talk about the wealthy in general. Again, if you're worth $100 million, most people that are worth $100 million or more, that whole net worth is not made of cash. A lot of the wealth that they have is tied up in assets, with let's say maybe a minority of that sitting in liquid assets like cash in their bank, or let's say a money market fund, or etc. So in order to pay the taxes that they are incurring, they're either going to have to secure a loan or sell off their assets. And basically, they need to pay off their taxes on unrealized capital gains. And once they actually sell it, they also need to pay on realized capital gains. So that means they need to accumulate even more money just to pay all these extra taxes. And let's say a lot of these super wealthy people, they're not just wealthy for no reason. They're not all lottery winners and they don't just have money for whatever. They're not really just individuals. A lot of them are business owners, or maybe these are businesses themselves that are subject to this tax. But what businesses like to do is that they like to pass on costs to the consumers. For example, what is one of the best ways to increase your stock price when your financials are a little bit down? For your quarterly board meetings, let's say for a public company. One of them is layoffs, because salaries are one of the biggest expenses. If you lay off a large or a significant number of your workforce, that pops your financials and thus increases your stock price, or helps you meet your financial goals, which increases your stock price. Let's say there's an increase to their supply chain. What do they like to do then? They usually like to increase the cost of the product offering, which then they pass on to consumers, or let's say they reduce the size of the product itself. So that way you're still paying more, but for less product. So these taxes, even if they're just, let's say, written to say that they're targeting people with $100 million net worth, it will trickle down and affect people that are, let's say, working for them or working for the business they own. Usually they will find a way to pass on the cost to other people. So this tax will actually affect people even aside from the extremely rich. And not to mention what a nightmare it would be to actually implement the system. For example, let's say publicly traded companies. You might be able to find their financial information online. You might be able to find what they're valued and such. What about private companies? What about, let's say, people who are, or just that wealthy? What about artwork they have or assets they have? It'd be a real nightmare to really manage it all. So to be frank, whether or not Kamala Harris is elected as president, I don't think we actually have to worry much about this at all. Because from what I'm hearing from a lot of speculation, this proposal is really just political theater. It's made and designed to appeal to that voter base where this actually sounds really nice. It's really just to get votes, get quick votes, and probably it really just won't be implemented. And that's really, again, all I have to say for this video. So thanks for watching. Please subscribe and share.